the markets are finally listening to the Fed, taking them seriously, and getting things priced in and reacting to the Fed. So the Fed is regaining some sense of credibility. The market's finally taking them serious and listening to what they said. More importantly, watching what they did. Markets were down as much as 800 points today, have about 30 minutes till close, down 2% on the Dow, 2.2 on the S&P, 2.3 on the NASDAQ. So markets are testing these June lows that we put in. I put out a couple of tweets earlier. Took a lot of heat back in that time frame, and we'll take a look at this right here. This was June 12th. The bottom is not in, so that's when the market bottomed for the first time before the big rally, where everybody was calling for the bottom. Some big YouTubers were calling for new all-time highs. So were some analysts out there and managers, investment managers. June 12th, that this is not the bottom. June 18th, we still have not seen panic selling or mass liquidations. This is very controlled unwinding so far. Lots of denial still out there. You will know panic when you see it. Why do I say that? Let's take a look at the markets here. Let's look at where we're at right here. This is the Dow. Here's the NASDAQ. Here's the S&P. So let's take a look at this. Here's the psychology of the markets. And when you take a look at this schematic here compared to this, you see a lot of similar looking price action where you're in that complacency area here. You get this rally where you get a little bit of anxiety and fear right there. Then you get a little bit of denial, which is kind of where we've been. Then you get that panic. No end in sight. Time to get out before I lose it all. So we're not there yet. We're still in this area here, right before the real big denial area. And there's going to be a lot of denial out there right now. A lot of people still calling for everything to, kind of bounce and rebound. This is the S&P. So S&P has not broke June lows yet. NASDAQ still above the June lows. The Dow, however, has broken the June lows. A little bit of buying up going on right now because it's also the Dow, which is interesting, is also finding support off of the 2020 pre-pandemic highs. So this was an all-time high for the markets before the pandemic. Price fell off a cliff. The Fed jumped in, put $2 trillion in the economy, and the market obviously went on to put in new all-time highs till November, December, when the Fed said the party is over and started the tightening cycle narrative and letting the markets know, hey, party's over, we're going to unwind this. And now inflation has reared its ugly head, and they can't bail the markets out this time. We're not going to see a V-shaped recovery like that, just like we saw in 2018 when the markets threw a fit right here. Fed jumped in and pivoted, and 2009 financial crisis when QE was invented or started, zero interest, trillions of dollars pumped into the economy off of that time frame. And then of course you have the dot-com bubble. And when you look at this price action here and you look at the psychology of the markets, looks very similar. That chart went away. Looks very similar to what was happening here. So we haven't seen panic selling yet like we saw there. We haven't seen panic selling yet like we saw here. And if the markets were to, like some analysts are targeting the March 2020 lows, if that were to happen, how far do the markets from all-time high, how far would that be? That would be a 50% drop on the Dow. The NASDAQ, I'm not saying it's going there. I'm just saying there's some analysts and there's some technical analysis that will target these March 2020 lows, and 59% on the NASDAQ, and the S&P, that would be 54%. So like I said, there is some technicals out there that would show that this is a target just based on previous, again, when you go back to the 2009 lows, and you start looking at when QE began and the money that was pumped into the economy that is now being sucked out. And then of course this right here. But first stop are these pre-pandemic highs. The Dow is already there testing it, finding support. The S&P and NASDAQ are on their way there if they break these lows here. And there's a potential that it could hang on here for a little while, might get a little bit of a bounce before it goes on to the next level down. And as you can see, kind of maybe this area here is where, if you compare the market cycles, it's kind of potentially where we are right now. And there's a couple of chartists out there overlaying S&P from this area to now. And it looks like we're right in that same area where price is going to just roll over, and we will see a panic situation. We haven't seen that yet. Retail has not sold yet. Retail is kind of propping the market up, and some of the bigger stocks like Apple, Microsoft, Google are still not down that much. So if those stocks start to sell off and match some of these other stocks in the tech sector and the S&P that are down already 60, 70, 80%, then that's when you could see markets potentially testing those 2020 lows. But I'm not calling for that. I'm just saying there is some technical confluence out there for that. Here's Bitcoin. Bitcoin is still rejecting on the 2017 high of 19,450, 19,500 basically, and working its way to ultimately recheck that June low, which it looks like it will definitely do that. And we'll see if that support will hold or if it breaks through and goes to the next level. So markets are holding up pretty well, but a lot of times crypto can lag traditional markets. Bitcoin can lag the traditional markets. So something to keep an eye on over the weekend after the close today. These markets are much easier to manipulate because they're much smaller than traditional markets. But again, when you look at, traditional markets in terms of the Dow and the NASDAQ and the S&P, and you look at Apple, right now, pretty much single-handedly holding up the NASDAQ. Apple hasn't really moved at all from previous all-time highs. Still a lot of work to do there to get back to the June lows. But if Apple starts giving up the goat here, then giving up the lead here, then that'll do a lot of damage to the NASDAQ. Same thing with Microsoft. Same thing with Google and a couple other companies out there. Tesla is still hanging on pretty good. And these are big major cap stocks that if they start to crumble could really have an effect on these indexes right here, especially the NASDAQ. So a lot of stuff out there, a lot of chips yet to be played that could potentially fall. But right now the Dow is finding support on that pre-pandemic February 2020 high before that big drop there. So we'll see if that'll hold, if markets can find a little bounce here into the weekend. We'll just have to wait and see where they settle out. And again, like I say, you always can tell, catching a little bounce there. It was down as much as 800 points on the Dow. You can always see what investors are thinking as we move into the close. And still a lot of headline risk out there, still a lot of things going on. But the narrative is, the message of the week is that the Federal Reserve is serious. They're going to get inflation down. They cannot reverse course. They can't pivot. They can't reverse course on interest rates. They have got to get inflation down. And the selling is going to continue. There are recession fears out there. There's a lot of risks out there in the credit markets. And then the bond market and the dollar are causing some damage out there. So there are definitely some black swans swirling that the bond market, the dollar, and the credit markets could potentially cause a liquidity event and an issue similar to what we saw in the banking crisis. Different, not the banks obviously, but different financial markets and financial conditions that can reverberate through the economy. If companies can't refinance their debt, then you're going to see some bankruptcies and some business closures and things like that, which creates layoffs, which feeds more into a recession. So these are the things the market is pricing in now, trying to get ahead of, and that's what you're going to see playing out. So the macro picture is leading the markets right now. And, to expect any kind of a market rally or reversal or any kind of new all-time highs is just not realistic, not probabilistic, nor is a Great Depression, style event. So just because markets are breaking June lows and testing pre-pandemic levels and going down 50% doesn't mean that's going to be a Great Depression. That's just not realistic either. The economy is strong enough to avoid something like that. And there are things that can be done. And I think in terms of the unwinding of valuations, there's a lot of capital out there. Markets get down 50%. There's going to be a lot of capital stepping in, propping up markets. But from an economic standpoint, a Great Depression type event without a major global meltdown is just not something that's likely, feasible, or remotely. I mean, anything's possible, but the likelihood and feasibility of something like that happening akin to the Great Depression is just not realistic in this day and age, given the global macro economy that we have, the consumption-based economy we have in the United States. We saw with the pandemic, everything getting shut down, 80% of the economy still continued to function. So people calling for Great Depression, it's just not realistic. It's just not probable, and it's kind of silly. And people calling for new all-time highs and melt ups and these crazy levels that you see some people call out there, looking for 60,000 on the Dow and 10,000 on the S&P, and just these crazy astronomical numbers. That's not realistic either. So right now, the ball is in the Fed's court. They are serious. They're going to get inflation under control. And these are the things I'm looking at. I'll see you in the next video.